In 2008, the global economy collapsed. Major banks failed. Stock markets crashed. More than 30 million jobs were lost worldwide. Governments stepped in. Trillions of dollars were injected into the system. The crisis ended, but something unusual happened afterward. The economy recovered. Corporate profits recovered. Stock markets reached new highs. Yet for the middle class, wealth stopped growing. This video explains exactly what changed after 2008. Not in theory, not in slogans, but in policy decisions, in data, and in incentives, and why the recovery worked extremely well for people who owned assets, but not for people who depended on wages. For decades after World War II, the middle class grew steadily. In the United States and across much of the developed world, productivity increased, and wages followed. Between 1948 and 1973, worker productivity in the United States increased by about 97%. During that same period, real wages rose by nearly the same amount. When companies produced more value, workers shared in that growth. Homes were affordable relative to income. In 1970, the average home cost about 2.5 times the average annual salary. Most wealth growth came from wages, not from speculation. Debt levels were manageable. Economic growth was not perfect, but it was broadly shared. By the late 1970s, this system began to change. Global competition increased, unions weakened, technology shifted bargaining power, wages began to grow more slowly than productivity. But the system still moved forward, until 2008. The crisis of 2008 was not a normal recession. It was a failure of the financial system itself. Banks had expanded lending aggressively. Risk was spread through complex financial products. Housing markets were tied to global finance. When housing prices fell, the entire system froze. Credit disappeared. Businesses stopped investing. People lost jobs at a massive scale. To prevent total collapse, central banks responded aggressively. In the United States, the Federal Reserve cut interest rates from over 5% to nearly zero. Then came a policy called quantitative easing. Between 2008 and 2014, the Federal Reserve created more than $3.5 trillion. That money was used to buy financial assets. Other central banks followed the same approach. The European Central Bank, the Bank of Japan, the Bank of England. The goal was stability, prevent collapse, restore confidence. And in that sense, it worked. Financial markets stabilized, large institutions survived. The global economy avoided a depression. But the recovery was built in a very specific way. And that design mattered. When interest rates stay near zero, borrowing becomes cheap, very cheap. Money looks for returns, and it flows where returns are easiest to find. Financial markets respond quickly. Stocks recover. Asset prices rise. Wages do not behave the same way. They depend on bargaining power, on job security, on labor market conditions. After 2008, bargaining power was weak. Job security declined. Temporary and contract work expanded. So growth took a different path. The stock market recovered rapidly. In the United States, the S&P 500 returned to pre-crisis levels by 2013. And then it kept rising. Housing followed. In many cities, property prices doubled over the next decade, but wages lagged behind. From 2009 to 2019, U.S. productivity grew by roughly 15%. Real wages grew by only 3 to 4%. This gap was not accidental. It was structural. Companies learned something after the crisis. They could grow profits without growing wages. They could automate. They could outsource. They could rely on flexible labor. Wages became a cost to control, not a channel for sharing growth. So even as economies expanded, paychecks stayed tight. The recovery showed up on balance sheets, not in household security. Now pause for a moment. And consider who benefited the most from this system. If you owned stocks, your wealth grew. If you owned property, your wealth grew. If you had access to capital, you could borrow cheaply and invest. But if your income came mainly from a paycheck, the story was different. Living costs rose. Housing absorbed more income. Education costs increased. Healthcare costs increased. Wealth moved upward, not outward. In the United States, stock ownership is highly concentrated. The top 10% of households own nearly 90% of all stocks. That means rising markets benefit a small group disproportionately. Housing followed a similar pattern. Those who already owned homes gained wealth. Those who did not faced higher barriers to entry. The recovery widened existing divides. Historically, major crises reset systems. Debt clears, asset prices fall, new growth begins. After 2008, that reset never fully happened. Interest rates stayed low for more than a decade. Markets became dependent on intervention. Governments feared another collapse, so stability became the priority. Even if inequality increased, the system recovered, but it recovered in place. And this changed how the middle class experienced the economy. People worked more hours, they earned more nominal income. But wealth accumulation slowed, risk increased, security declined, upward mobility became harder, not because people stopped trying, but because the structure changed. The middle class did not disappear overnight. Its trajectory shifted. Momentum was lost. And once momentum disappears, it is very difficult to regain. Growth continued, but it was distributed differently, quietly, systematically. So the question is not whether the economy recovered. It did. The real question is this: who was that recovery designed to protect?